Google generates billions in profits, but I'm still not buying it. Why? Because even a great business can be a terrible investment at the wrong price. But is Google price really wrong? At what price does it become an incredible buy? In this video, I will show you exactly where I see fair value, how I analyze this company, and why Google could be a massive win for investors like us. I'm not here to hype the stock. Before making this video, I compare hundreds of companies and ran thousands of calculations. The conclusion? Based on my data, Google is the most undervalued of the Magnificent Seven, so I decided to talk about it. Like always, this is not financial advice, it's just entertainment. There are many ways to evaluate a company and every investor has a favorite method, but I don't like copying others, so I invented the value ratio. Similar to discounted cash flow, it focuses on three main factors: earnings, growth, and risk. We must nail down these three variables precisely to value any company correctly. Let's start with earnings. When we buy a business, it's to make money. So, how much do we really earn if we buy Google now? Most people just accept the income of the official report, 100 billion. That's a big mistake, because earnings can be heavily manipulated by accountants, and one-time revenue and expenses can distort the picture. Others look at free cash flow, which is better but not perfect. Google reported 72 billion in free cash flow, roughly unchanged since 2001, but free cash flow includes 22 billion of share-based compensation, which dilutes investors, and it's not ideal for us. Also, it doesn't account for 7 billion in extra receivable, and more importantly, the billions Google invested in artificial intelligence and cloud last year and plan to invest even more this year. I think it's fair to say that Alphabet spend in capex more than usually to give an extra push to dominate AI and cloud. If we adjust for those extra investments, I estimate Google real earnings around 80 billion. Still with me? Do you think Google is more or less efficient than the other Mag 7? To gauge efficiency, let's compare the gross margin to the owner's margin. With 350 billion in revenue, 80 billion is a solid 23% margin. Among the Magnificent Seven, Apple, Microsoft, Nvidia and Meta are more efficient, while Amazon and Tesla fell short. Google sits on a sweet spot for investors. Margins are not so low to be a problem, but are low enough that they might be improved like Meta did. In summary, Google accountants make some magical wizardry to present us with 100 billion, but we see through it and we establish that the real earnings are 80 billion with 23% margins. If they expand margins by 2-3% soon, that could generate a lot of value for investors. Let's move to the second pillar, growth. How fast can Google revenue grow in the coming years? Yes, the past doesn't predict the future, but Google's been compounding revenue at 18% over 10 years. Analysts forecast 11% for the next 5. I think that's reasonable. Google search might slow down. LLMs are changing search. Nerds like me search less. That's just reality. But I doubt search ads will vanish overnight. YouTube search might accelerate. I mean, I'm making videos now. Everyone will watch me, right? Subscription and Google Clouds are growing fast, so should balance search deceleration. 11% growth feels right, but I wouldn't be shocked to see 8% or 15% from Google. Let me know if you would be interested to see how different growth prediction change fair value. Now let's talk risks. Google is stable and predictable overall. Zero bankruptcy risk since it carries more cash than debt. Low dilution risk. There is 22 billion in share-based compensation, but it also buy back 52 billion last year, so share outstandings are down over the past decade. Possible risks. 1. Nvidia chips are useless, meaning Google is investing heavily in AI, but it will never bring positive operational cash flow. I doubt it, but it's a tiny possibility. 2. AI could disrupt classical search faster than Google can adapt, bringing ads revenue to zero. Again, not likely, but a real long-term risk. 3. Regulators have an ongoing witch hunt against Google monopoly. I don't agree Google is a monopoly, but regulations are a real risk to consider. Overall, I would rate Google risk at 25 out of 100, where 1 is no risk at all and 100 is a tiny, unprofitable Chinese startup drowning in debt with no cash flow. Before I reveal the final numbers, a quick thanks to you guys. I just started a couple of months ago and my videos get around 500 views, with maybe 100 of you arriving at this point. If you're one of those people, you are the best. Honestly, I couldn't do it without you. It means so much to me that you stick around. Thank you. Putting it all together, Alphabet has 350 billion in revenue, 23% margin with 2-3% possible margin expansion, 11% growth, and 25 out of 100 risk. This gives a value ratio of 19 versus a market average of 26. If Google would align with the market, would mean a price of $250. So today, Google is 37% undervalued by my metric. So why I'm not buying it immediately? Honestly, I'm tempted almost every day, but I have a personal rule. I want at least 50% upside. I would buy at $168, which may or may not happen, but today $185 isn't expensive, it is an investment to consider, but the market always serves up new opportunity, so I'm not really worried on missing out on this one. Do you own Google? If not, at what price would you buy? Drop a comment, like, subscribe. Peace out.